Alrighty, this is the 8th video on the Maybe series and the 16th under accounting. And in this one, we're going to be talking about how asset sales, whether they're at a gain or a loss, are going to affect the three financial statements. So I know in the last video, we talked about asset purchases. In this video, we're going to be talking about asset sales. So something to keep in mind, and this is a really, really important thing. On our income statement, we do recognize gains and losses on asset sales. And that's really, really important to keep in mind, right? So let's say that I have a cookie stand, right? And in this cookie stand, I buy a stand mixer, right? And I pay $400 for this stand mixer. But then I realized I don't actually need it, right? So I try to return it and they say, no, you can't return it. So now I have to try to like resell this, right? So then the best I can do is resell it to someone for a bit cheaper. So I resell it to them for $300 and I take a loss of $100, right? This loss of $100 is on our income statement, right? We are going to recognize this loss on our income statement because what is our income statement? It's our P&L, right? It's our profit and loss. So this loss is going to be on our income statement, right? Similarly, if I had instead sold this at $500, well, that $100 gain would be on the income statement, right? So not the full proceeds, right? Not the $500, that's going to be on the cash flow statement, but the gain or the loss is going to be on the income statement, and that's something that we really, really have to be careful about. So let's look at an example. Let's actually do an example of a loss on sale first, because I think there's something that's a little bit easier about that. Right, so let's say that I bought something at, let's not say something. Let's say that I bought equipment, right? At $100 and I sold it at $60, right? So essentially what does that mean? I had a loss of $40. Let's assume there's a 25% tax rate, right? So how's that going to look on our income statement? Well, on our income statement, actually, let me write the other ones out first. On our income statement, we are going to recognize this loss. So something that I have been kind of making as a simplifying assumption on our income statement was that it goes our revenue minus our cost of goods sold. That gives us our gross profit. We subtract out our operating expenses. That gives us our EBIT. And then I was just subtracting out interest here, right, or interest expense. But in reality, you actually also subtract out your losses and you add back your gains, right? And there's a couple other line items here, but I think it's better if you learn it video by video rather than learning all of it all at once. It's not something that's important enough that you have to know from the very get-go, right? And that gives us our earnings before taxes. Then we subtract out our taxes, and then we get our net income, right? So let's say that we bought equipment at 100 and now we're selling it at a loss, right? We bought this equipment at some previous period. We're selling it in this period at a $60 loss. I mean, sorry, a $40 loss. We're selling it at $60. So what is that going to look like? Well, we are going to recognize this $40 worth of a loss right here. What that's going to do, that's going to adjust down our earnings before taxes by $40, and then our taxes are going to be $10 less. We have $10 of tax savings, meaning that our net income is only down by 30, right? So hopefully that makes sense on the income statement. Now let's move on to our cash flow statement, and here it's a little bit more complex, but hopefully I can make it a little bit clearer for you guys. So our net income is down by 30. However, I want you guys to think about this. Is this loss a cash loss? Did I lose cash in my hand? No, right? I didn't actually lose cash on hand, right? So because of that, I need to make sure that I adjust for that on our cash flow statement, because this net income number is not representative of the actual cash change for that company. So we're going to add back to this under cash flow from operations for losses. We're going to add back that loss because it's a non-cash loss, right? And then once we have done that, we basically just corrected this little bit here, right? Now we're going to take into account that we sold it at $60, meaning that we got an additional $60 as a proceed of the sale, right? So in terms of proceeds of sale, we got an additional $60, right? So let's net that out. That is 70. So the change in cash is a positive 70, right? And let's think about this with a different perspective, right? What happened? I sold some equipment and I got $60 of cash on hand, and I got $10 worth of tax savings, right? Because of the loss. So that's 10 extra dollars that are going to be in my hand, and the $60 that I got in terms of the proceeds from that sale, meaning that I have $70 more of cash on hand, right? So now we can move on to our assets. We have our cash, right? So that is a positive 70. But then I sold this equipment, right? As of right now, and under PP&E, it says that I have $100 worth of equipment, right? But now I sold it, right? I no longer have this, so I need to take this off the books, right? So we're taking off this 100 off the books, right? So we're adjusting this down by 100, right? Or I could write a minus 100 there, right? So what does that mean? Our total assets are down by 30. Let's talk about our liabilities. Any change there? No, right? Nothing happened to our liabilities at all. And now let's look at our shareholders' equity. Well, our shareholders' equity flows through from our net income. So we have $30 less in terms of our shareholders' equity. So let's look at our formula here. Assets equals liabilities plus shareholders' equity. Well, we know up here that we had a positive 70, then we had a minus 100, and that gives us a minus 30 overall. And we know that our shareholders' equity is a minus 30 overall. So because of that, our balance sheet balances. Right? So now let's look at a example of a gain on sale. Right? So let's say that I own some PP&E worth, what should I make it worth? Let's say 100, right? This is, instead of say worth, let's say that I paid 100 and I sell it at 140, right? And there's a 25% tax right here, right? So let's look at our income statement. We're going to do basically the exact same thing that we did up here, right? We have all the way down here, we have our EBIT right? That stays flat. Then we're going to subtract out interest. We're going to subtract out losses. No losses here, no interest here. But now we're going to add back the gains, right? And here we do have a line item, right? What's the gain here? It's $40. So we have an additional $40, meaning that our earnings before taxes are up by 40. We subtract out our taxes. Now we're going to be taxed $10 more because we had $40 extra of income. That's 25% of 40, right? We're going to be taxed on that 40 extra dollars. So our net income is going to be up by 30. Now let's move on to our cash flow statement. We flow through that net income increase of $30. But again, just like in the losses example, this gain is not a cash gain, right? So we're going to have to reverse that. So the gain, we're going to reverse that because it isn't correct to say that, oh, I got $40 in terms of a gain on the sale. What would be correct is to say that, oh, I got proceeds of $140, right? So this net income figure is essentially not representative of the actual cash changes. So because of that, we're going to reverse this gain. And then after that, we're going to recognize proceeds from the sale of 140. Right? So overall, our cash is up by 130. And let's think about it in the same way that we thought about the example before. I got $140 worth of cash on hand, but I had to pay $10 of taxes on the gain. So how much extra cash do I have on hand? I have $130 worth of cash extra on hand, right? So let's look at our balance sheet. Under our assets, we have our cash that's up by 130. Now again, our PP&E, this was written on our books as 100, but we have to take this off our books now. We paid $100 for it. That's what it's going to sit at on our books, right? But now I've sold it, so I have to get rid of this off of my books. So because of that, we're going to subtract 100 here, meaning that our total assets increased by 30. Again, no change to our liabilities. And for our shareholders' equity, that flows through from our net income. And that's a plus 30, right? And let's check if our formula still holds. Well, we had an additional 130, and we had a negative 100 on the asset side, and we had an additional 30 on the shareholder equity side, and this nets out to 30 here, and that shows that our balance sheet balances, right? So hopefully that makes a bit of sense in terms of kind of walking someone through these. These are actually not super common, but in terms of accounting questions, this is one of the more common ones because it is a little bit more advanced than some of the material that we've done so far. So it does kind of test the understanding of how these three statements link together. So I would say it's relatively common in the accounting space. Now, overall, in terms of all investment banking interview questions that you would get, this is still relatively unlikely, but I would say that this is something that I would be comfortable with relatively early on. So I hope, I hope you guys kind of understand how asset sales in terms of gains and losses look like on the three statements. So I hope that's been helpful, and we'll hop into the next one.